I think there are five upside risks. Taking each of these points in turn, the first point, earnings revisions have turned positive for the first time in nearly 4 years, both in America and globally. That is normally a good sign. The second key point, the equity risk premium is around 5.75%. That's a long way above its long-run norm, which is around 4%, but also considerably above where our models say the equity risk premium should be, which is around 5.25%. The third key support for equities is I think that policymakers are slowly shifting from negative interest rate policy towards a policy which is focusing more on fiscal easing. And as that happens, you want to move out of deflation hedges towards inflation hedges. The fourth factor, which I think is positive for equities, is what we call excess liquidity, M1 over nominal GDP rising at about 7%, consistent with a sharp re-rating of markets. And finally, it should be borne in mind that positioning data is fundamentally quite cautious. In other words, since the market low, the only net buyer of the market has been the corporate sector. They've bought 14% of market cap. One final little point is this is a seasonally propitious time of year. Between October and April, on average, markets rise about 10%. I think my main worry at the moment is US wage growth. If US wage growth picks up, and there are signs that that is happening, that has three negative impacts. First, it squeezes corporate profit margins. Secondly, it tends to push up the government bond yield, which makes equity to bond valuations less attractive. And thirdly, it may cause the Fed to become more aggressive. And the risk is if the Fed were to become too aggressive, that would slow down economic growth. I think the other risk out there from my perspective is still China. A year ago, that was really all everyone was talking about. Today it is slightly off people's radar screen, but there has been very little fundamental rebalancing of the Chinese economy. The investment share of GDP is still higher than any other economy has ever had, and the increase in credit relative to GDP in the last 7 years has been bigger than any other economy has ever had other than Ireland. So I think we have to look very carefully at the indicators in China. The ones we're particularly looking at are real estate lead indicators, the loan to deposit ratio, and PPI deflation. It is currently emerging markets. We went overweight emerging markets somewhat contentiously at the end of last year. In reality, we see four main things supporting emerging markets. Unit labour costs are falling for the first time in nearly 6 years. That supports profit margins. The second key positive is that emerging market currencies are about 30% cheap, at least when we look at them against export market shares. That is excluding the renminbi. If the currencies can go up, then basically inflation falls, interest rate falls, net foreign debt falls. The third positive is we're seeing a clear improvement in relative economic momentum in emerging markets versus developed markets, and earnings momentum in emerging markets versus developed markets is close to a 6-year high. And the fourth positive is emerging markets have policy flexibility. Of course, the worry in emerging markets is it's become somewhat of a consensus long. Yes, inflows are at a 4-year high, but if you look at those inflows, there's still a tiny proportion of the outflows we had since 2011. And if you look at the valuation, you're trading on a 15% sector-adjusted PE discount to developed markets. It's perhaps worth pointing out that most investors say, well, emerging markets are playing on the dollar. If a dollar weakens, then emerging markets outperform and vice versa. That I think is wrong. Since May, we've seen the dollar appreciate, but emerging markets have actually outperformed by 8%. I would also add one other issue, that in developed markets we're worried about politics. We've got the politics in developed markets of re-regulation, and in emerging markets we've got the politics in many instances of deregulation.